Good morning, Frank. So we are over the halfway of this year, and I must say, if I look back, if you look at the noise in the markets and if you look at the press, people would think that we're having a horrible time in financial markets. But yes, I do think sometimes one needs to look back and actually look at the performance of what has happened, and that's where it differs.
You're right, Theo, and there's been some interesting news coming out lately. The one I'd like to talk about is the June CPI figure that came in at 5.4%. And it's the first time in 14 months that this figure is within the central bank's target of 3 to 6%. What does this mean for interest rates going forward and financial markets in general?
Look, Frank, I think first of all, one must be careful to take one simple reading of an inflation number. And now I'm not talking about only South Africa, but international. Don't take one or two readings and say that is where we are now. But what we are seeing is the Reserve Bank locally, they are sticking to their mandate. Now, yes, it hurts people who are paying off debt, who's got mortgages, who's got other kind of debt. It does hurt them, but the key element from the Reserve Bank point of view is it shows the absolute independence of the Monetary Policy Committee, and it also shows their determination to get inflation back into the target range of 3 to 6%, but actually to get inflation to the middle of that target range of 4.5%. And we are moving in that direction. And I do think, just to hover a bit on that, we need to understand that the mandate of the Reserve Bank in terms of keeping inflation intact, thereby actually looking after the purchase power value of our rand, both internally in terms of inflation and externally, is a key determinant of a stable working economy. The minute monetary policy, and with monetary policy I mean specifically things like inflation, gets out of hand, that is when a currency completely collapses. So for as long as the central bank sticks to its mandate and brings the currency in a range of between 3 and 6%, that will create behind the scenes, or that will create the strength that we need for an economy to sustain a level of inflation on the one side and the currency on the other side. But there's another element to that, and we're seeing that not only in South Africa but worldwide. This massive increases we've seen in inflation worldwide is slowly starting to come down. Now, historically, when inflation comes off, it will be followed at some point by interest rates starting to ease, and that usually is a good signal for flow to more risky assets. And that flow to risky assets includes flows to emerging markets, of which South Africa is one. So we need to look at that and realize that this inflation coming into the target ranges, we might not have seen the peak, we might still see bumps, but at least we're closer to the top of the inflation cycle than to the bottom, and we are starting to get closer to interest rates starting to come down.
And Theo, I suppose it's always hard from a timing perspective to talk about timing here. But, as you said, we're more likely to be towards the top of the cycle. That doesn't mean there won't be any more interest rate hikes, but we're closer to the top. And it also may not mean interest rates come down very soon. They might stay at these levels for a while. But at least we are seeing signs that we might be closer to the top of the cycle, and that is positive news.
That's certainly positive for investors. Usually, as you usually find that as you get to the move into the interest rate cycle where interest rates are starting to come down, you usually get equity markets and emerging markets, of which South Africa is one, strengthening. Does that mean it's going to happen tomorrow, or the next day, or the next year? I've got no idea when it's going to happen, but the history tells you that the minute or when monetary policy start to loosen, there's liquidity going into riskier assets, of which South African equities will be one. But if you take a step back, Frank, and just look at the markets and the performance of our markets. And I just took a stock standard balanced portfolio. So a standard balanced portfolio, remember now, inflation year on year is at 5.4%. We're below 6%. Over the past 12 months, a standard balanced fund gave you somewhere between 12 and 15% for the 12 months. A standard, more conservative fund or stable fund over the last 12 months would have given you somewhere between 9 and 11%. So we've actually been outperforming inflation handsomely since the beginning of the year, but over the 12 months. If you look at the last 3 years and you look at the average performance over that 3 years, a stock standard balanced fund over those 3 years gave you something between 12 and 14%. Remember, inflation was around 6% over this period. And a more of a guarded or a conservative fund would have given you between 9 and 10%. Again, handsomely outperforming inflation. So while we're seeing this negative news and this feeling of things are going nowhere, your investment portfolios are actually telling a different story. And that comes to the point that a portfolio should be a diversified, as diversified instruments in, and that's exactly what we're seeing. That diversification in terms of bond market, money market, local equities, international equities are actually delivering exactly what's on the box.
Yeah, Theo, I mean, thank you for that good news. You know, we have had a lot of negative news over the last 12 months. If I think about the negative news that's been coming through, we've had high inflation, interest rates going up. In South Africa, we've had higher and more sustained levels of load shedding. The rand's been weakening. There's been tensions between the US and South Africa over the Russian ship that docked in Simonstown. So it's a helpful reminder that investment returns have been positive and helpful and done, you know, what we've expected them to do, regardless of all of the negative news that we've seemed to have been hearing over the last 12 months.
Well,
and go ahead.
No, that's exactly why the portfolio manager is getting remunerated, specifically to say, but wait a second, we need to build the portfolio, structure the portfolio to be able to sustain this kind of environment. Absolutely
correct. And some other good news in the last month or two, Theo, has been that the rand has strengthened over the last few months. What should investors consider now that the rand is closer to 18 rand to the dollar rather than 20 rand as it was 4 or 5 months ago?
Look, I think when it was closer to 20 rand, obviously it was concerning, and we find that there is underlying volatility in the currency as a small emerging market. Unfortunately, a lot of our problems are problems that are self-induced. It's problems that we are responsible for. And that creates a lack of confidence in the South African environment, and it creates uncertainty. Now, the key view is that 20 rand to the dollar, the rand was too weak. It was a knee-jerk reaction, but around about 18, or even if at some point we start to go a bit stronger, I think what investors can do at these levels is, again, look at their international exposure. And if they are underweight, talk to your advisor and put a strategy in place to make sure that you get your international weighting to where you should be. This decision should not be done when the rand is 20 to the dollar. It should be done in these kind of levels and make sure we get to that level. But having said that, if you look at our standard solution for most investors in the balanced fund, in a balanced kind of solution, we need to be careful. The equity market in South Africa is at historic cheap valuations. It is undervalued relative to the last 20 years. It has only been at these valuations once or twice in the last 20 years. The bond market, where you take the capital side and the money market side, that's also providing yields that we haven't seen for the last 10 or 20 years. If you now add to that we are at the top end of interest rates worldwide, yes, it might take longer, it might be more difficult. The key message is, if you are somebody that is contributing on a monthly basis either to your pension fund, to your retirement fund, or to a unit trust. My view would be is if that is where you are, seriously look at doubling that contribution for the next few months. Why do I say that? Not because things are going to turn, not because things are going to go suddenly up, not because things are going to go better in South Africa, simply because if I look at the underlying elements that provide the value and the performance of your portfolio, we always talk about the asset classes. Those underlying asset classes, specifically where they relate to South Africa, is currently offering value. And yes, it might not turn in 6 months or 12 months or 18 months or 24 months, but the point is you are getting more for your buck now than you have had in a long time. So if you are a contributor to a pension fund and you've got a 10 or 20 year view, or to a unit trust with a 10 or 20 year view, if you can afford it, double your contributions for the next 3 to 6 months. You are getting more bang for your buck. In terms of international markets, that's a different perspective. But the point there is that with a currency where it's currently, carefully look at your underlying international exposure. If you are underweight, this is the time to consider upweighting your international exposure.
And Theo, typically with our clients, what we do is we try and phase in those investments. So what you're saying is if you're doing a regular contribution, consider increasing that regular contribution. Don't try and time the market.
No.
Don't try and put it all in one go. But if you are needing to upweight your offshore investment, or you are doing regular contributions into your retirement fund or into your investment, now's the time to consider slightly increasing those contributions and continuing to phase in these investments over a period of time.
Yeah, and don't get distracted too much by the noise out there in the market. You noted the things that concern investors currently. If I just look at the balanced portfolio since the 1st of January this year, balanced portfolio since the 1st of January is up between 7 and 9%. Inflation around about 5.5% or 5.4%. That tells you that the underlying building blocks in these portfolios are actually doing what they should be doing. So be very careful to look at the news and equate that to your investment decisions. Your investment decisions should be rational. It should be based on fundamental risk-return profiles of your asset class weightings, not on what is on the front page of the newspaper.
So don't let your investment decisions be driven by your emotions. We often see when the rand bombs out and goes to 20 rand to the dollar, that's the time that people start rushing to buy dollars. And what we're saying is be rational, take a long-term view, stick to your investment plan and your decisions, and approach them methodically.
Yes, and talk to your advisor, because the key there is that a big part of that is to try to remain rational and stick to the long-term objectives that we've agreed for you, and that the portfolio is structured in such a way that we've got the maximum ability to achieve those long-term goals.
Yes, and I think what you're reminding us there is that we play an important part in our clients' lives in helping them to navigate through all of the news and all of the noise and all of the fear, and to stick to their plans and to continue to make rational decisions when it comes to their finances.
Yes, and just to be sure that what was written on the box, what was written in the plan, if you look at the performance over the past, since the beginning of the year, the past 12 months, the past 3 years, that is what markets and solutions are actually giving us. So it's although the news is not great, it's a nice space to be in. And I just remind you, if you're concerned about it, go and look at your statement. If you look at your statement and you measure what the portfolios did, you're actually achieving what you want to achieve.
Great, Theo. Well, thank you very much for this discussion. I found it very interesting and insightful. Thank you so much.
All the best, Frank, and we speak again.